Accounting is the language of the business, and hence, to know how well business is doing, it is important to understand for a business owner certain accounting terms. Hi, my name is CA Jithendar Patel, and I am on a mission to help small and medium enterprises with hassle-free statutory compliances. Many business owners struggle with accounting terms like revenue, income, direct expenses, assets, liabilities, and so on. In this video, I am going to share important accounting terms which will be helpful for every business owners. So let us get started. Revenue. Revenue is the money generated from the normal business operation. Revenue is also known as sales, gross receipts, etc., and also called the top line of the business. This is one of the important figure which every business owners need to check every month to check whether the business is growing or not. Revenue may be from sale of product or from providing services. Sometimes the revenue and income are interchangeably used. Whereas the revenue indicates the total sales of the company, income indicates the net profit earned by the company. Direct expenses. Direct expenses are the expenses which are directly attributable to manufacture or purchase of the product of the company. Examples of direct expenses are wages paid, freight charges, consumables, etc. Direct expenses help in finding out the gross profit of the company, which is one of the important indicator of the financial health of the company. Indirect expenses. Whereas the direct expenses are the expenses which are directly incurred for the manufacture or purchase of goods, the indirect expenses are not directly related to sale of goods. Indirect expenses are the cost incurred in the daily operations of a business. They are not related to the product sold in any direct manner. Examples of indirect expenses are office rent, telephone, internet expenses, salary to the office employee, etc. Indirect expenses can be further classified as office and administrative expenses, marketing, selling and distribution expenses, financial and other expenses. Gross profit. In simple terms, gross profit is the profit earned by the company by subtracting the purchase and direct expenses from sales. For example, if ₹100 pen is sold for ₹120, then we can say that the gross profit earned by the company is ₹20. This is one of the important indicator of the financial health of the company. A healthy gross profit has a direct impact on net profit of the company. Net profit. Net profit is the profit earned by the company after deducting direct, indirect, depreciation and tax expenses from the revenue of the company. Net profit percentage is derived from net profit divided by sales into 100. This is also known as the bottom line of the company and one of the important indicator of the financial health of the company. Net profit helps the business owner to know whether it is generating enough profit from its sales or not. Assets. Assets are resources controlled by a firm with an expectation that it will help to generate future cash flow. Example of assets are land, building, inventory, cash and bank, etc. Further, these assets are classified into fixed assets, current assets, finance assets. All the assets of the company appear on the asset side of the balance sheet. Fixed assets. Fixed assets can be classified into tangible and intangible. Tangible assets are the assets which can be seen, like for example land, plant and machinery, furniture and fixtures, etc. Intangible assets are assets which cannot be seen, like patent, copyright, trademark, etc. Moving on, current asset. A current asset is a company's cash and other assets that are expected to be converted to cash within 1 year of the date appearing in the heading of the company's balance sheet. Example of current assets are inventory, cash in hand, cash at bank, trade receivables, etc. Equity. The capital contributed by the business owner and the profit earned by the company together contribute the equity of the company. Equity is also equal to sum total of assets minus sum total of liabilities. It also represents the amount of money that would be returned to a company's shareholder if all the assets were liquidated and all the company's debt was paid off in case of liquidation. If a company has a good equity, it means it can borrow more from the finance organizations. Liabilities. Liabilities are the amount owed by the company to the outsiders. Examples of liabilities are loans, trade payables, accrued expenses, etc. All the liabilities of the company appears on the liability side of the balance sheet. Further, these liabilities are classified into non-current liabilities and current liabilities. Non-current liabilities are liabilities which are payable after more than a year. Examples are long-term loans and borrowings like term loans from banks, directors, or any of their relatives. Current liabilities. Liabilities which are repayable within a period of 1 year are called current liabilities. Example of current liabilities are trade payables, expenses payable, short-term loans, etc. Hope understanding these accounting terms will help you in understanding the financial health of your company in a better manner. For more informative videos like this, do subscribe to my channel. This is CA Jithendar Patel signing out. See you in my next video.